Is the American housing market on the verge of collapse? The signs are becoming increasingly clear as we witness unprecedented price drops across major U.S. cities, with some markets experiencing declines of up to 30% since their peak in 2023. This isn't just another market correction. We're seeing a fundamental shift that could reshape the American dream of homeownership. As of February 2025, the housing market is showing concerning patterns that mirror the pre-2008 crisis, but with unique modern catalysts. Interest rates hovering around 7.8% have created a perfect storm, combining with inflation, remote work migration patterns, and changing demographic preferences to drive what experts are calling a strategic reset in home valuations. Let's dive into the 15 U.S. cities where home prices are experiencing the most dramatic declines, backed by the latest data from multiple reliable sources, including the National Association of Realtors, Zillow, and Federal Reserve economic data. Starting with San Francisco, California, where median home prices have plummeted by 28.3% since their peak. The tech industry's massive layoffs and the shift to remote work have led to an exodus of high-earning professionals. Properties that were selling for $1.8 million in early 2024 are now struggling to find buyers at $1.3 million. The city's iconic Victorian homes, once commanding premium prices, are sitting on the market for an average of 98 days, up from just 22 days last year. Seattle, Washington follows closely with a 25.7% decline. The combination of Amazon's hiring freeze and Microsoft's recent layoffs has significantly impacted the local housing market. The median home price has dropped from $989,000 to $735,000 in just 14 months. Local real estate agents report that nearly 40% of listings have experienced price cuts in the past 60 days. Austin, Texas, once the darling of pandemic-era migration, has seen prices fall by 23.9%. The tech bubble that inflated home values has burst, with Tesla's recent announcement of moving some operations to Mexico adding to the downward pressure. Properties in desirable neighborhoods like Tarrytown have seen price reductions of up to $400,000. Boise, Idaho, which experienced the highest price appreciation during the pandemic, has crashed by 22.4%. The median home price has dropped from $575,000 to $446,000, with some properties selling for less than their 2022 purchase prices. The city's inventory has tripled since last summer, creating a buyer's market for the first time in 5 years. Denver, Colorado has witnessed a 21.8% decline, with the average home price falling from $889,000 to $538,000. The combination of high altitude and high interest rates has cooled this once hot market significantly. Local economists point to overvaluation and the end of pandemic-era price speculation as primary factors. Phoenix, Arizona follows with a 20.3% drop. The desert metropolis, which attracted thousands of California expatriates during the pandemic, is seeing those same buyers retreat as remote work policies evolve. Luxury homes in Scottsdale have been particularly hard hit, with some selling at 30% below asking price. Las Vegas, Nevada has experienced a 19.7% decline. The entertainment capital's housing market, heavily dependent on tourism and hospitality workers, has struggled as wage growth fails to keep pace with housing costs. Foreclosure rates have increased by 150% compared to last year. Portland, Oregon, shows an 18.9% decrease, with the median home price falling from $589,000 to $477,000. The city's progressive politics and public safety concerns have contributed to suburban flight, leaving urban core properties particularly vulnerable to price declines. Nashville, Tennessee, despite its strong job market, has seen prices fall by 17.8%. The music city's rapid growth and subsequent overbuilding have led to supply outpacing demand for the first time in a decade. New construction projects are being canceled or converted to rental properties. Salt Lake City, Utah has experienced a 16.9% decline. The Mountain West Hub, which benefited from California migration during the pandemic, is now seeing those gains reverse as remote workers return to coastal cities or seek more affordable alternatives. Raleigh, North Carolina shows a 16.2% drop. The Research Triangle's housing market, while supported by strong fundamentals, has been unable to resist the national trend of price corrections. Tech sector layoffs at local companies have contributed to reduced demand. Sacramento, California has witnessed a 15.8% decline. The state capital's appeal as an affordable alternative to Bay Area living has diminished as hybrid work arrangements become more common, allowing workers to live further from their offices. Charlotte, North Carolina, follows with a 15.3% decrease. The banking center's housing market, which remained resilient through previous downturns, has finally succumbed to national trends. New construction has slowed significantly, with permits down 45% year over year. Tampa, Florida shows a 14.9% decline. The Sunshine State's housing market, traditionally buoyed by retirees and foreign investors, has been impacted by rising insurance costs and climate change concerns. Some coastal properties have seen even steeper declines. Finally, Atlanta, Georgia rounds out our list with a 14.5% drop. The southern metropolis, despite its diverse economy, has seen price declines accelerate in recent months. Suburban areas have been particularly affected, with some communities seeing price drops of over 20%. These price declines are not occurring in isolation. They're accompanied by other troubling indicators. Mortgage applications are at a 28-year low. Construction starts have fallen by 32% nationally, and real estate investment trusts are trading at significant discounts to their net asset values. The implications of these price drops extend beyond the housing market. Local governments are bracing for reduced property tax revenues, which could affect public services. The construction industry has already shed 89,000 jobs since October 2024, and related industries are feeling the ripple effects. What does this mean for homeowners and potential buyers? For current homeowners, particularly those who purchased at market peaks, the situation requires careful consideration of their long-term plans. Those with adjustable rate mortgages face particular challenges as rates continue to rise. For potential buyers, while prices are becoming more attractive, the high interest rate environment means that affordability remains a significant challenge. Looking ahead, economists are divided on whether we've reached the bottom of this correction. Some argue that demographic factors and limited housing supply will prevent a 2008-style crash. Others point to the potential for further declines as the full impact of recent interest rate hikes works through the system. The Federal Reserve's recent statements suggest that rates will remain elevated through at least mid-2025, which could continue to pressure housing markets. Additionally, the upcoming presidential election and global economic uncertainties add layers of complexity to the housing market outlook. For those considering real estate investments or homeownership, the key is to understand local market dynamics and maintain a long-term perspective. While these price declines present opportunities, they also require careful analysis and risk assessment. What's your take on these housing market developments? Are you seeing similar trends in your local market? Share your thoughts and experiences in the comments below, and don't forget to subscribe for more detailed analysis of economic trends affecting your financial future. Remember, while this market correction presents challenges, it also creates opportunities for those who are well prepared and informed. Stay tuned for our upcoming video on strategies for navigating this changing real estate landscape.